Hi everybody, it's Wes with Pikes Peak Trades. And in this video, I want to focus specifically on metals and miners. We've seen back-to-back Fridays so far in January with heavy selling on both the spot price of gold and silver and some individual mining names and the mining ETFs getting hit very hard. And lots of chatter on Twitter. Lots of opposing views here about whether gold and silver are actually in a bull market, whether this is just a bear market bounce, or if we actually are going to see a resolution in a more inflationary environment to very, very high prices in the metal and the mining sectors. Now, I'm not going to get into any of the fundamental or the geopolitical analysis. That's not my specialty. I just want to interpret the charts as I see them. I just want to lay out in front of you the evidence that I see. So we're going to begin with the GLD monthly chart using the ETF GLD as a proxy for spot gold. And what I'm charting is still a very bullish count within the middle of a primary wave of a cycle three. So we are still in the middle of what I think is the most bullish sequence within Elliott Wave, where we're in that middle set of huge wave threes up. Okay, now the question is, where exactly are we at? And have we set a more intermediate term low that will follow through to these ambitious targets? So looking at the monthly, I want to point out to you that the monthly candle that we've had here halfway through January has simply set a higher high and a higher low. Right now, there is no significant technical damage to this long-term count. If I take you back through other topping areas, what does alert technical damage that a trend has changed? If I take you back through the top of what I'm calling cycle one that ended the 2001 to 2011 metals bull market, we see in this monthly candle, we see almost a bearish outside candle. We got a higher high and a lower low, a closing low well under the previous month's closing high. If I take you over here to what I have in August of 2016, the end of that month, that I think topped the first primary wave of this cycle three. And look at what we got. We got a lower high, we got a lower low, and a monthly close well beneath the previous month's high. Do we see any of that, all of that, part of that? Well, we certainly have the higher high. Didn't even get that at the primary one top. We have yet to put in a lower monthly low. Okay, now with that said, GLD is very close. So the reversal level that is required for it to turn around, the margin of error here is pretty slim. Now, on a closing basis for the month, that's my point. If we close with a completely outside bearish candle, that's when I think the technical damage has occurred. If it spikes lower than this previous month's low, end of December 2020, we've got a warning shot. So yes, we should be in a place of caution. As of right now, I don't think we can fully sound the alarm bells that we've seen back here at the end of August, the top in metals. So until further technical damage is there, the evidence that I have here suggests that this is just a pretty healthy pullback. Now, even if it does pull back beneath this intermediate four low, a primary count says it could go all the way down to the low 150s, and that would not be out of the realm of possibility. In order to do that, we probably would have to get that bearish outside candle followed by probably 2 more months of selling. Okay, so we got to wait. We got to wait to see what happens on when futures open Sunday night into part of Monday, what happens Tuesday, and then we got to see the rest of this month play out. If I now take you to a weekly chart, you're going to see what I think is actually a bullish candle. So I interpret candles like this that are just slightly lower than the previous week, where the close of the week very, very close to the open as an inverted bullish hammer. And essentially the reasoning here is that price attempted to open the week on a low. Buyers tried to push it up. Sellers pushed back. In this case, right at this resistance area on the 8 and 21 week EMAs. But they couldn't push it significantly lower, is the idea. That there's still either a lack of sellers or enough underlying buying strength that we couldn't quite bust this into a fully bearish candle. That's my interpretation. That also fits with an Elliott wave count. So if I now take you to the GLD daily, you're going to see that we can count from the late November low. We can count 1, 2, 3, 4, 1 up into a minor wave. And we can count an A, B, C down into a minor 2 wave. Now, if you're only using the daily chart, you're probably bailing on your positions. Because yes, we closed significantly under the 200-day moving average. But as I just showed you on the monthly and weekly, you got to have the longer term time frames in mind. If you're a shorter time frame trader, fine. Let the daily be your guide. In my opinion, there's a lot of noise on the daily charts that can drown out the longer term signal that you really want in order to be really profitable. So this minor 2 low can go all the way down to 166 if it needs. We've got lower rail support if we happen to get a quick dip lower when cash markets open Tuesday. When you see the SLV chart, I'll explain why I think that actually could happen. If I take you now into the short-term chart, I want you to notice this divergence. So if you were only interested in a short-term swing, I think at the end of day trading on Friday, I think you got your entry. You have RSI and MACD divergence on a potential minor degree low. I think that will be at least good for a bounce up to challenge this moving average, maybe even the top of this bear channel that we saw a fake breakout. My thought is that this is actually the ceiling and settling of a significant low. So let me now take you into SLV. So SLV here, we're looking weekly. I want to show you that same inverted bullish candle here. And SLV as opposed to GLD, okay, you see that's on the monthly. Let me show you the weekly. Okay, beneath its 8 and 21 day weekly EMAs, and SLV is relatively stronger. Barely below its 8 EMA, above its 21. And again, in an Elliott wave count that I think could signify a significant minor degree low. If I take you now into the smaller time frames on SLV, looking here on the daily chart, not too much to notice except to say again, if you're only using the daily, you might have panicked and said, well, it's below the 50-day SMA, I'm going to get out. You know, just because it closed below the 50-day SMA doesn't mean it's going to go down any further. On the shorter term time frame, we're going to see what I think put in a leading diagonal for a wave 1 down to a wave 2. And what we want to see is we want to see 3 waves down. So I think we got an A, B, C. Okay, now, if this does turn into another spike low, we don't want to see a count that could count as 5 waves down. But I just want to alert to that possibility that perhaps we need one more spike low, maybe a 1, 2, 3, 4, 5 to finish off this C leg to seal some more divergence. Okay, but the indication of the evidence I have right now is that I think Friday we saw a significant low. Okay, I think we saw that low, and we're going to have to see what happens. Let me now get you into the mining space. So let's take a look now at GDX here on the weekly. You're going to notice last week I said, hey, I'm optimistic because we got a rail hold, we got an MA hold. You know, just because you held these MAs doesn't mean you're going to hold the next week. And so, of course, on the flip side, just because you lost them doesn't mean you can't regain them. So just using only one chart, again, let's try to keep this in context here. Yes, miners are much more beaten up, so got a little bit of concern, okay, going in to this coming week. If I take you into GDX now on the daily, what I want to point out here is some hidden divergence. So we see a price closing low above what I have as a minute degree low, but we see both RSI Stochh levels that have been pushed lower. And the idea behind hidden divergence would be it's taking more energy to make momentum move lower while price isn't actually accompanying. So that kind of hidden divergence could actually signal the bottoming process. Now, by this count, obviously, we need this minute wave to hold. Okay, so short-term traders, you've got a very, very clearly defined and tight stop level. It would be this low right here. If that is broken on Tuesday, we've somehow got to fit into here a 5-wave count to turn that into a minor 1 and a minor 2 like you just saw on GLD. Now let's look at a couple individual names. And I still think a couple compelling charts. I really like this cup and handle setup here on First Majestic, ticker symbol AG. We've got the move up, strong move up off the March lows, a painful correction. Okay, we've got the beginning bull moves, I think initiation moves of very, very aggressive upside targets. There's your cup, and here's your handle. So we've got back-to-back selling weeks. Yes, this is painful to watch, but do you notice even here on the weekly, AG is above its entire moving average cluster. Has there been pain? Yes. Is there technical damage from this chart? No, not yet. Trade the chart that you have as evidence in front right now, and this is offering a classical TA pattern with the potential for an Elliott wave and moving average support that could at least not make us panic this weekend, okay, and at the most offer really excellent entries or additions. So let me take you to a more detailed count here on AG, and you're going to see we have not yet violated my original nested 1, 2, and we're still looking for a minor 3. Obviously, this is now the invalidation level, but if that breaks, as long as 11.27 holds, it can be a minor 3, minor 4, and then we're going to be looking for an extended minor 5 all the way up until some point in quarter 2, 2021. Let me get you through 2 more names before I finish. I want to get you into CDE. Okay, and we're going to notice again, like I pointed out, this is a monthly chart on GLD. Have we had pain? Yes. Is there technical damage? Not yet. Not yet. So far, it's an inside month. Cordaline was up 46% in December. This pullback got knocked back twice at significant long-term rail resistance. But so far, painful, yes. Damaging, no. Looking at CDE on the weekly, I would have actually loved to see that rail hold, but we lost it a bit just because we lost that 8-week. We don't have to sound alarm bells yet. Now, a count adjustment was required when price traded below 8.98. But ultimately, That just shifts it to a nested 1-2. Yes, below the 50-day, yes, but looking at the longer time frames, we've still got some optimism that all of these targets that I have for us looking out into the first half of 2021 can be reached. So last name, and then the video will end here. I don't have Hecla on the weekly. Want to show you just an updated chart for Hecla on the daily. Very similar in its counting with CDE, slightly different nesting. And again, all this did was just make the progressions more bullish. When sell-offs happen this deep, but they're still in a series of higher lows, all that does is push your Fibonacci projections out more aggressively. That's the way that Elliott wave works. So I hope some evidence is showing you I do not believe there was reason to panic. Now, pain, yes. Should we have caution antennae up? Yes, we should. We don't want to see some of those key levels continue to get broken. But if there is support to be had and a reversal movement back up to be made, I think we could have seen, hopefully, some of that capitulation happen at the end of trading on Friday, January 15th.